Howdy, hot shots. It's the Dividend Daddy, your favorite, not a financial advisor with not financial advice. And yesterday I was talking to you about GDXY and gold and precious metals in general and why they may do well after a rate cut. We've already seen them start to spike after the rates were cut last week, and that's for multiple reasons. There is lower opportunity cost if you are going to invest your money in something that isn't spinning off an income when the rates are lower. If you have high rates, then you could put your money in a CD. You could put it in a high yield money market. You could put it in treasuries. You could put it in bonds. And you're going to be getting a pretty high income. As rates start to drop, it costs you less and less of that potential gain to move into something for capital preservation or capital growth, like precious metals. Another reason is that a lot of times when rates are cut, it's because there's cracks in the economy. They see problems coming down the pike and they're trying to head them off, but the Fed is always late. So when they cut rates, people get a little bit nervous about what kind of shape the economy is in. That means a safe haven asset like precious metals, where capital preservation is the goal, it becomes more attractive because people are like, well, we're scared to invest in stocks right now because the economy is showing cracks. Rates are lower, so it's not going to make us very much if we put it in bonds or CDs, fixed assets. And so now we can put our money over here just to preserve our buying power and wait for a rainy day when the stock market goes down, and we can move our money into that and gear more towards growth. So it's a risky asset in one regard, but it's also a risk-off asset where people are like, okay, we don't want to invest in companies with high valuations, but we don't want to have our money just sitting doing nothing. So what do? Well, we put it in precious metals, and we hope that keeps up with inflation. Because a lot of times when there's lower rates, there's more inflation because it's easier to get money. And so then there's more dollars chasing fewer goods, and that leads to inflation. So precious metals, being an inflation hedge, now become one of the de facto investments that money will move into. If we're cutting rates, that means that the dollar is also less in demand because people don't need to convert their assets to dollars to invest in American assets so that they can get a higher yield. And if the dollar becomes less attractive, then that means that all of that international money needs to go somewhere too. And what do? They put it in precious metals, and then the precious metals will hopefully keep their buying power until they also find a better investment opportunity. Now, over a long period of time, that's pretty much what precious metals have been, is a capital preservation. It protects your assets from inflation. In the short term, they can outperform or underperform. Okay, in the short term, they can rock it up. And that's one of the things that I think could happen with silver, because historically speaking, silver had a 12-to-1 price ratio with gold. So 12 ounces of silver would be worth 1 ounce of gold. Right now, you know that silver's down around $40-ish, but gold's at $3,600. So that's somewhere in the 90 ounces of silver to 1 ounce of gold. And that's not really a good ratio. Silver has a lot of industrial demand, and silver gets used up a lot faster than gold. Most of the gold that's been mined is still in existence today. Still being held by somebody somewhere. Not a lot of it gets thrown away. There's a little bit that gets lost in computer boards and cell phones and stuff like that. But silver is in a lot more things. They'll have silver in batteries, they'll have silver in solar panels, and then a lot of that just winds up being destroyed or used up or being put into a landfill somewhere. So silver disappears. And silver will almost be a byproduct when they're mining for something else, and then they run into some silver and they'll go ahead and mine that for a while and they'll get the silver out. Now, there are dedicated silver mines and there's dedicated silver miners. And the Amplify Funds has a junior silver miners fund called SILJ. SILJ will invest in these small mining companies, and a lot of those present a lot of volatility. They have a lot of upside, but they have a lot of downside potential too. Some of them go big and some of them go bust. And so they are a volatile asset, and they're riskier than investing in a big established miner. What they have done is they've created an income fund that focuses on that asset, SILJ. So they've got SLJY, and that invests money in exchange traded notes and that underlying SILJ. They also invest in some of the companies that are held in SILJ separate from SILJ. And they do all of this so that they can use it to write covered calls and get you those covered call premiums that we like to talk about on this channel, because we are, dividend and distribution hungry. We want that income. So SLJY has a targeted yield of 18%, which doesn't sound that huge when you think about assets like Ulti that are paying 88%. But what we have to know is that SLJY is selling further out of the money calls, and their goal is not just to have that income, but also capital appreciation and exposure to the performance of that underlying SILJ. So it is quite possible that your total return could wind up being much higher than if they were just targeting income and getting a higher yield to begin with. But 18% really isn't anything to sneeze at. Just a couple short years ago, people would have been happy with 6 or 7% because there wasn't all that many high yielding funds. There were, BDCs and stuff like that would pay 10 or 12%, but those were pretty risky. A lot of them would just pay out, would wind up going down further than what the yield you were getting. You could buy individual stocks and then sell covered calls on them, or sell cash secured puts and generate your own premiums. But that's pretty labor intensive, and also you have to have kind of a lot of working capital if you want to have exposure to many different companies. So you could go and you could buy SILJ and then sell your own covered calls on it, but it's only a 0.75% management fee to have SLJY that does it for you. Then you have professional management. You have somebody who's already been in the space because they are the ones that started SILJ. And then they're also buying individual stocks outside of SILJ that would take you a lot more capital to go and do. So 18%, that's still over 4 times as high as what you're going to get from SCHD. If you put $100,000 in, you're talking about $1,500 a month in targeted income that they are trying to give back to you, still with the potential to have capital appreciation through the performance of the underlyings, which include SILJ. And so I will be adding SLJY to my holdings. I'm going to start stacking some of that because I'm a fan of silver. I have a lot of SLV. I have some individual silver miners, but I haven't been selling covered calls on my silver miners. I just buy them and sit on them, and some of them have performed well. Some of them spun off from other companies, and so I own a little bit of those. But a lot of my silver miners are actually foreign companies, and so then I have to deal with foreign taxes. I get more tax forms at the end of the year. They're withholding money from any kind of distributions that I have. So it's not exactly tax advantageous for me to hold those individual stocks when I could be holding something that's spitting me off an income of 18% a year. So, $100,000, you get $1,500 a month in targeted income, and it is a monthly payer. It's not a weekly payer. That sounds pretty dang good to me. And because I am confident, it's not guaranteed. Past performance is not indicative of future results. And, I'm not a financial advisor, but I am confident in the future of silver and gold. And I don't have to worry about whether those assets are going to go away. And as long as there's silver and gold, there has to be silver miners and gold miners. So some of them may not be profitable. If oil goes up in price, that can make it very expensive for them to get the gold and silver out of the ground. If silver and gold go down in price, and then they still have to continue mining it, and they still have to continue selling it, even if it's at a loss, just to keep their company going. So then that can, use up the reserves that they have in the ground at prices that aren't really good for them as a company. But overall, I'm pretty happy with the idea of investing in something that is recession-proof-ish, right? Like gold and silver aren't exactly correlated to the stock market. They aren't exactly correlated to the housing market. They're not exactly inverse either. So if there's a crash in everything, if there's an everything crash, silver and gold will go down. But I am quite confident that they'll rebound. As long as the companies don't go out of business, a lot of their valuation comes from how many ounces are believed to be in their holdings in the ground. And the fact that they can scale back their production and then increase their production when prices go up so that they can maximize their own profits out of the ounces that they have in the ground makes them a pretty attractive investment to me. And to be able to invest in those and get some capital appreciation as those go up, but also get a pretty good income spun off of it without a lot of labor and research of me going and looking at the stocks and the bonds or these options every single day and trying to figure out which strike to use. And maybe I miss a week and so I'm not getting income that week. Or maybe, you know, the options get exercised and then I have to decide whether I'm going to roll them or whether I'm going to just go ahead and lose the asset and then try to get back into a cash secured put or something like that. I can let somebody else do all that work, and it costs me less than 1%. It's around 0.75% for that product right now. That sounds pretty good. So let me know down below, would you rather buy SLJY with an 18% yield and capital appreciation possibilities, or would you rather buy GDXY with a 44% yield last time I looked at it, and they also are having a little bit of capital appreciation? But it seems to me, and I was trying to look on Amplify Fund's website and see, it looks to me like they are actually holding some of these assets in the fund. It's not all synthetic. GDXY is synthetic. So there's an added risk there in that if a synthetic goes down in value, you can't really just hold it forever until it comes back because it's costing you time value. If you're actually holding the assets, you can just hold it until they come back and hopefully recoups your original investment, plus you've gotten a yield off of it the whole time. All right, D-Gens, let me know what you think and I'll talk to you later.